Happy Friday, Dave.
Hey Nick, how you doing?
Fantastic. Sun is shining. It's a beautiful fall day, and we're talking about the economy, which
Yeah,
surprisingly is a fun thing to talk about because things are going pretty well.
yeah. It's been an interesting year, as was the year before. But we continue to live in interesting times, as the old Chinese proverb that you're supposed to use with your enemies goes. May you always live in interesting times.
Yeah,
We,
there
we
you go.
do
I like
indeed.
that.
We do indeed. So
We
yeah,
do indeed.
stock market here as we roll into the end of the year is up 24.8% since January, as measured by the S&P 500.
Yeah, I mean, absolutely just a phenomenal run for the stock market this year. And I think that surprised a lot of people. And I would
Hmm.
also say, to some degree, scared a lot of people as well, in terms
Right,
of, we had this major pandemic. And then if you go outside and you hear about what's going on and you see what's going on, it maybe doesn't translate to a 24% return on the stock market. Yet here we are.
right, right. There's an old market cliche that a bull market climbs a wall of worry, right?
Right.
And we've definitely lived that over the last 2 years at least, and plenty of things to worry about, plenty of things catching the headlines that sound really negative. Meanwhile, the market just keeps on chugging along. So, why would that be? Why, right?
Right.
And I think at the end of the day, what we've gone through with the pandemic, the market has seen that as a passing phenomenon. Meanwhile, corporations are continuing to grow their earnings, and the government response to the pandemic, of course, had a lot to do with where the
Mm.
markets are now, making sure that there was plenty of money flowing into the economy at a time when otherwise we might have seen things really grind to a halt. And so now people have money to spend and are looking for things to spend it on.
Yeah, absolutely. Ton of money to spend, and part of the reaction is keeping interest rates low, which is why we've seen really kind of a boom in the refinance and allowing a lot of people to buy
Right.
homes and do different things with low interest rates. So it does have a big, widespread impact, which is interesting.
Yeah.
Um, and
Yeah.
and one of the things that we've talked about before on this podcast that I'm sure has some merit in what we're seeing, but from a technology standpoint, I think we really advanced a lot faster than what we would have had we not had the COVID shutdown.
Right.
And so there's a lot of things that really accelerated, almost, some experts are saying, we're 10 years further than we would have been had we not had it. And I'm sure
Right.
that has an impact on business and profitability.
Right. Right. It forced us all to figure out how to work from home and rely on systems, and where before we just took it for granted that we had to commute to an office to do any work. Um, yeah, kind of turned that on its head and sped up that cycle in a way
Hmm.
that
Yeah,
ultimately may be a good thing. So
for sure.
yeah. So you know, as far as where we're at, one of the concerns, one of those worries now is where the stock market is compared to where corporate earnings are. And
Hmm.
as of yesterday, when I ran the charts that we're using for today, and those charts will be available on our website with the link to this podcast. Uh, while the market's up to almost 25%, price to earnings ratios, which is how we measure value in the stock market, is sitting at about 21.4. That means for every dollar you spend on a stock, it represents about $21 in earnings and what they expect companies are going to be generating down the road. And that's near a high. So, to put it in perspective, the tech bubble back in 1999, 2000, price to earnings ratios got up to 24 and a half. And So that's kind of like the high water mark that we measure everything against. And so we're not quite there, but the market basically means the market is optimistic
Yeah.
about where earnings are headed and where growth is headed, and expecting that those company earnings are going to catch up with it.
Yeah, that's a great point, and we've already started to see some of that. I mean, if you're looking at this chart, you can see that we're actually off of some highs. Looks like we got
Mhm.
just about to 24 and down to 21.4, and a lot of that is because earnings have come in really well
Right,
as a part of that. So that, obviously with a price to earnings ratio, there's two sides of it, right? The price or the earnings.
right,
And so if the price goes down and the earnings stay constant, the PE ratio goes down, and vice versa.
exactly,
If the price stays constant and earnings go up, the PE ratio goes down. So it's just a
right,
matter of what one of those things is driving that. And so we've
right.
seen a little bit of a pullback from the high in 2020, but like you said, 21.4 compared to the tech bubble of 24.5. So it wouldn't be,
Well,
unheard of for that number to go up or, stay where it is or start trending down. I mean, there's a lot of options. It'll be interesting to see what happens.
yes, yes. For context, too, the historical average is 15 and a half. So, so we're well above average, but we're still below the peak by about the same amount. So,
Yeah.
when people come in and say, well, stocks are expensive, there's no room for them to go up. I think you nailed it there. Yeah, price to earnings ratios will return probably to a more normal number. An optimist would expect that it would return to a more normal number because earnings rise, where a pessimist would expect it to return to a more normal number because the market goes down.
Right.
Um, and the truth is, it may be a combination of the two, right?
Absolutely. And probably the most likely is a combination of the two. And it's just interesting to me because, this is a question that we get quite a lot right now, right? So
Mm-hmm.
stock market's doing really well. I see my statements. The economy doesn't seem to be doing well. When's the bottom going to fall out? And my answer to that has been could be next month, could be 3, 4 years from now. We just have no way of telling what that looks like. And to play the game of trying to guess it is not in your best
Well,
interest.
right. And um, if you look at historical earnings per share and compare those to where the market is at different times, what ends up happening is whenever the market always seems too expensive.
Right.
If and you can end up sitting on the sidelines and missing a bunch of growth that way.
Absolutely. And so, the tried and true practice is to not try timing, to make sure you have the right risk, right diversification, right mix of risky versus non-risky assets so that when inevitably there's always going to be a correction, right? Because that's kind of how the
Right.
market works. And so that you're prepared for that and you're not surprised by it and you can ride it through. You're going to be way better off with that philosophy than trying to say, okay, things are expensive. So move everything conservative, move everything to cash until things calm down. Because if that's 2 or 3 years, we could have made the same argument, last year and then sat out this year and missed a
Mm-hmm.
25% gain in the market.
Mm-hmm. Yep. And we've covered that idea quite a bit in past podcasts, but it's never gonna feel right, and that's back to that wall of worry, right? If
Right.
if nothing feels like there's risk involved in the market, there's probably not going to be any return then either. And
Right.
we
Exactly.
think back to the definition of investing is to take a current risk in hopes of a higher return down the road. And if there wasn't that element of risk, if there weren't those things to worry about, there'd be no return. We'd make the
Hmm.
1.6%, 10-year treasury rate if we were lucky. So,
Right.
um, and the second slide in our deck here kind of speaks to that too. This year the market's sitting here up year to date about 25%, and we had a -5 pullback from the peak in August ish. And so far, that was the worst of the year, was a pullback of 5% there, as when China changed some policies around, and inflation numbers started to not look as pretty. But the average year sees a market drop somewhere along the line of 13.5%.
Mm-hmm.
And that includes really good years and really bad years. But that volatility is part of what we sign up for, and you can't have that long term return of the markets around 10% without also expecting every year you're going to have downturns in the middle.
Right, exactly. To the point of being prepared for that, that kind of fluctuation, and making sure that are diversified, but also, you plan for the withdrawals that you need and how much risk that you're going to have. Because, like you said, every single
Hmm.
year, you should expect at some point to be down 13% as far as your equity holdings go.
Yes.
Um, and a lot of what that means, and that's on average. So that means a lot of years it's going to be worse than that.
Yep. Yep. So, the big element in the economy right now that seems to be on everyone's mind. Well, there's a couple of things, and they're related, but inflation is kind of the big question mark right now.
Yeah,
And
definitely the second most popular question we get is what's going on with inflation and how's that going to affect me?
right, right, and as of when I ran these charts yesterday, uh, the consumer price index year over year change was about 6.2%, which is pretty much the highest it's been in 2 decades,
Yeah.
which sounds horrible. But, when you dig into that a little bit, first of all, um, the last 2 decades have been extremely low inflation scenarios. And if you look at historical averages, that's on the 6.2 is on the high side, but it's not anything that's so alarming in the bigger picture. And the other part of it is we're still unpacking what part of inflation, how the different elements of inflation that we're dealing with right now are related to the pandemic and supply chain disruptions versus things that are likely with us for the long term.
Yeah, that seems to be the big question in inflation is, kind of where it's coming from and how is it going to stick around in terms of, is it supply chain issues or is it more related to a core, underlying thing going on with the economy? And it will be interesting to see what plays out. And I guess my guess would be there's a combination of both those things going on. So I don't think we're going to go back to super low inflation like we have in the
Right.
past, but I certainly would expect those numbers to kind of come down back to a more normal average in that 2 to 3% range.
That seems to be the expectation, is higher than what we've had over the last few years, but what we're seeing right now is still an effect of, and we've talked about this over the course of the summer too, and that we're still dealing with supply chain disruptions and issues from mills being closed. And some of these things we're already starting to see straighten out. Like the price of lumber has already started to come back to more normal territory as people postpone construction jobs, and more construction lumber gets produced because of the high prices, drawing mills to do more. But some of these things, like the auto chip situation, they're going to take a little while to work out. Um, but then other inflation that we're seeing, like around wages, with a lot of our frontline workers, nurses, people that really took the brunt of what we've gone through over the last 18 months, 2 years now, um, are demanding more money to work, and probably rightfully so. And also, food service industries and things like that. We're going to see that sort of inflation, I think, stick with us.
Yeah, absolutely. I mean, you can't drive down the road without seeing, help wanted signs out there. And what that means is if you've got, a shortage in the labor market, you're going to have to start paying more.
Yeah.
And so that in order, if you're going to pay more for workers at McDonald's, then the price of the burger is going to go up and it's not going to come back down.
Yeah.
So that's definitely one side of it. But the other side, which is the supply, there's a lot more money, like we talked about, because some of the government spending and stimulus and things like that. So there's more money out there, and because
Hmm.
of it's harder to get things, those prices are going up. But eventually, we would assume that those things would kind of equal out a little bit.
Yeah. And, you know, there's still, while we're seeing unemployment come back towards more normal numbers here after all the messiness last year, we're still not quite there. But we're also seeing a really low number in what's called the labor participation rate, and that measures the percentage of folks. I believe it's under the age of 62 that they use, might be under 65, that are working as opposed to not working. And that
Hmm.
number right now is well below historic norms. It's around 62% right now, and I think it's usually in the 70s. And they are attributing that to a lot of people that just took early retirements last year, or, you know, decided that whatever they were doing wasn't worth it. And, one spouse staying at home versus both going back to work, different scenarios like that. So that's pushing some of that inflation too.
Yeah, we've seen it's been a real hot topic in the Wall Street Journal and a couple of other major newspapers of the Great Resignation. Right, all of
Yes.
these young people who decided that the job that they were in, they figured out during the pandemic it wasn't what they wanted for their lives,
Yeah.
and so they basically gave up good paying jobs to go do other stuff. So that's
Hmm.
another interesting dynamic on the flip side of that, the younger generation kind of looking and coming out of COVID and thinking there's
Hmm.
more out there and they want to do something different, even if it means not making as much. So I think that's
Yeah.
something that's definitely interesting as well.
Yeah. Yeah. And we've talked about that over the last 18 months about how what we went through kind of helped people reframe priorities in a way. And,
Mm-hmm.
the way that sometimes doesn't happen without, extreme sicknesses or near death experiences, that people kind of refocused on what they really wanted to do in life. And,
Yeah.
so that's driving some of it too. But my point of view is that those things tend to even out. There's going to be plenty of, for every person that resigns from a good job because it wasn't as fulfilling. There's someone else that's probably ready to try to
Right.
step into that role. If it's
Yeah,
a
for
good
sure.
job. So it'll be interesting to see how that plays out over the next couple of years. My guess is that on the low end of the wage scale, we're going to see inflation, and we probably need to see some inflation there. But some of that middle stuff will sort itself out.
Yeah, well, it's also interesting, if you think of, the lower end obviously is coming up, but the higher end is kind of staying stagnant because,
Hmm.
what we had is a lot of places who were hiring people. So let's say if you're out in California and you have a job in California, and you need a wage premium to live, to have a living
Right.
wage out in California. But because a lot of those people are working virtually and can work from anywhere and have decided to move out of California,
Hmm.
that they're not getting that same wage premium because the cost of living to work remotely from Montana is way different than California. And so we're seeing
Right.
some of that on the top level where a lot of these larger companies were paying more for people in California, that they're not having to do that now because essentially everybody's virtual and they can pull employees from anywhere. And so that's kind of leveling out some of that top level wage too. So that'll be
Yep.
another interesting thing to follow as the years go on, and kind of
Yep.
what transpired out of the pandemic.
Well, when we talk about inflation too, it's important to remember that you can't have a growing economy without some inflation.
Yeah.
And when the Federal Reserve, and we're going to talk about interest rates here in a minute and how that relates, but when the Federal Reserve talks about their goals, it's to keep inflation around 2%, not zero. It's to keep
Right.
it around 2%. 2% average, long term average is their goal, and that's because without with the only reason, well, the bottom line is the economy cannot grow without producing some inflation. And it stinks if you're a consumer and you're paying more for things. But in terms of the overall economy, you're shifting money from my pocket. If I'm going out to dinner tonight and I spend more than I would have last year, it's not like that money just vaporizes. It just goes into someone else's pocket and then they're
Right.
spending. And
Right.
so the thing to keep in mind is that from an economic standpoint, that inflation is not necessarily a bad thing or as big a deal as it is on an individual level. And then the other thing, the financial planning concept to keep in mind, is what keeps pace with inflation over time if the economy is growing?
Stocks.
The stock market. Thank you. Afraid you weren't going to come through for me there. So, you know, but at the end of the day, inflation's bad for bonds and good for the
Mm-hmm.
stock market. So even if you're a conservative investor overall, you need to have some money in the stock market just to keep pace with inflation on your portfolio, because that's where you get it back. If I'm spending more going out tonight, I can rest assured that if that inflation is hurting me today, it should be helping me down the road when those people spend my money on other things and grow the economy.
Right, exactly. And that goes back to kind of that original point that we made of yes, the stock market is, the PE levels are high, but you still need some stock exposure for the long-term growth
Hmm.
of your portfolio and just having that balance between stocks and less risky assets like bonds
Right.
and having cash. If you go, if you went all in cash right now because you were afraid of the stock market, inflation's gonna, do a number on you,
Yeah.
and vice
Yeah.
versa. If you go all into the stock market when there is a correction, that's going to do a number on you as well. And so figuring out where you need to be from a balance standpoint based on what your goals are is extremely important right now.
Yeah. So the other part of that whole equation with inflation and the stock market is interest rates.
Mm-hmm.
And we have seen interest rates come up quite a bit over over the course of the year, which, I mean, in percentage terms, in terms of the change is high, but the returns are still low. But right now, the 10-year Treasury sits at 1.6%, and the 2-year, the short term, is at 0.52%.
Yeah, which on the face of it doesn't seem like very much, but given where we were coming from, it's like you said,
Hmm.
it's quite an increase. And it's funny, I was in a meeting with a mortgage person today, and we had talked about that. Yeah, interest rates are a little bit higher. We're talking about a 30-year mortgage at like 3.6 to 3.8, but we think it's high because it's been as low as 2.5 or a shade
Yeah,
under three. And
yeah,
realistically, those are still really good numbers for a 30-year
right,
mortgage. Like
right,
amazing,
right,
numbers that you probably won't see for another 20, 30 years.
right, right. So the Federal Reserve uh, controls interest rates on the short end by what banks charge each other for overnight lending. And the expectation right now, so the Fed funds overnight rate is at zero. The expectation right now is it will probably see four increases over the course of the next year to get it back close
Mm-hmm.
to 1%. And that's a pretty big move, but that's what's built into the market. And remember, backing up a minute ago, we talked about how inflation is bad for bonds, and part of that is because bond rates are fixed, and so when inflation's higher, the money you're getting in the future for the bonds is worth less. But it's also part of the function of what alternatives are out there, and as the federal funds rate goes up, existing bonds out there look less attractive. But we don't right now, with four interest rate increases priced into the market expectations, that doesn't seem so dubious to me.
Yeah, for
That's
sure. And
the
I think the Fed's
expectation.
being real careful about how they want to attack increasing interest rates. And, keep in mind their number one charge has always been keeping inflation under control. And so,
Right.
you know, I think they're doing a good job of kind of taking it slow and see what happens. But ultimately, those interest rates are gonna go up for a couple different reasons. One, because of inflation, and two, because
Hmm.
if something happens to the market, that's their number one arrow that they pull out of their quiver is being able to lower interest rates. Well, if interest rates
Right.
are at zero, you can't lower them.
Right. Right. And the lower they go, the less effect it has. Um,
Right.
as rates have changed this year, we have seen the yield curve get steeper, which means that um, you're paid more for using longer term investments, sort of CDs and bonds. The farther out you go in time, the higher the rate. And that's actually a good sign for the economy.
Hmm.
Um, and one of the warning signs of a coming recession is when the yield curve gets inverted, which is means basically that short term investments can pay you more or as much as longer term investments. And that's not the case right now. And that points to the economy, the general feeling that the economy is healthy and growing, that down the road rates will be higher and inflation will be at least under control.
Yeah, like I said, definitely be something interesting to watch as far as their reaction and when they come out with that stuff. But yeah, like you said, definitely looking at interest rate increases, and the Fed's always good about kind of being the world's worst kept secret, because they don't they don't want any surprises when it comes to what interest rates are, what their plan is with interest rates, and they give us a long leeway in terms of
Yes.
when they're going to increase them. And usually it's like a small increase just to say, hey, by the way, we really mean that we are going to do this. And then they start going up a little bit more substantially.
Right.
So, and that's
Right.
all in
There's a
response to
whole
making sure that the markets don't freak out.
right. There's a whole industry of Fed watchers out there in the media
Mhm.
whose job is to parse every word that comes out of Powell and
Right.
everyone else's mouth, and to try to get a clue as to where the markets are going to head, because what they
Yeah,
say and what they do moves markets.
wasn't there, was it, I think it was like Alan Greenspan where they used to watch like what he was like, what briefcase he was taking into a meeting or something
Right.
ridiculous like that.
Yeah. 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 And one of the other things going on with the Fed, and we've got a slide in here that shows this, is you know as Nick mentioned a few minutes ago, they can only lower the overnight rate so much. The other thing that they do in times of crisis is buy bonds themselves and basically take them off the market. And what that does is creates artificial demand for bonds, and which in turn ultimately results in lower interest rates, because bonds and bond yields and bond prices move opposite each other. So when the government steps in and buys more bonds, they drive the price up, which drives the yield down, in a nutshell.
Right. And
So
that something that came out of 2008 when they were buying but also, buying subprime mortgages, and even I think moved
mhm.
into some equity type stuff that they're purchasing now. So they have a pretty um, diversified balance sheet themselves, as a response to,
Mhm.
obviously 2008, but also the pandemic. We saw a lot of that as well.
So here we are as things are starting to recover. They've started to telegraph that they're tapering off. You've probably heard of, they're talking about tapering it. So not stopping buying more assets at this point, but slowing down the amounts they've been buying. They currently hold about 8.7 trillion in assets. The Federal Reserve does. And so, just to give you an idea of the sheer amount, sheer volume that they control. But so as they slow down their purchases, that allows interest rates to rise a little bit too. So
Yeah, and that's been a
ultimately, by
dramatic.
raising, go ahead, sorry.
So I was going to say that's been a dramatic increase from where we were sitting in 2008 at 905 when we started, and to go from 905 to 8.7 trillion. They've
Right.
been doing a lot of work in the last, uh, you know, 14 years or so, which has been interesting.
Yeah. Well, and this chart of the Federal Reserve balance sheet that we're both looking at right now, it'd be nice to juxtapose a stock market chart on top of it, because they've got labeled on here when the Fed started to slow down their buying after the financial crisis. And I remember there being a sharp correction in the stock market around that time that they actually called the taper tantrum. So So, the idea this time around is to like let us all know that that's happening so that the stock market doesn't overreact. Um, and just keep in mind the reason they want to let rates float higher is because higher rates will slow the economy and then inflation down a little bit. And while that little bit of inflation that we talked about is a good thing, out of control inflation creates problems, creates violent swings in the economy.
Yeah, absolutely. So we've talked a lot about obviously the U.S. stock market and the bond markets. Another thing that obviously we're watching is international markets.
Mm-hmm.
Um, Developed international markets had a pretty decent year at 9.5%,
Mm-hmm.
but we still sit in that spot. I know we've had these conversations before around why should I be investing internationally when the US market's doing 24% and international markets are doing 9.5.
Yeah. Yeah. And so yeah, less than half the return in the international markets right now, year to date, than what we've seen in the US. So my big thing is looking back at valuations, right? We were talking about how the U.S. stock market is near the top, kind of high average for where its prices are compared to corporate earnings. The U.S. stock market is at that point because it's outperformed everything over the last couple of years, and at some
Mm-hmm.
point, the value, the fact that and I wish I don't have the PE ratio for the international markets handy, but it's below average because their returns haven't matched ours. So, if you were looking at what's on sale out there in terms of stock purchases, it's in international stocks, not in the US necessarily.
Yeah.
But, as portfolio managers, we always have to remember that there's more risk there too, because on top of the normal economic risks, you bring in political risks and you bring in currency risks and other things too. So we need to keep it in perspective. But, to answer your question, why do we own international? Well, at some point, we're going to see international outperform, and the longer it underperforms, the longer it's going to outperform.
Right, absolutely. And the same principle applies to, why do we own stocks when we know that they're, a little bit more expensive than they are on average? The same reason why we buy international and US is we don't want to make a judgment on which one's going to do better. And these things tend to be cyclical. And so by having both in the portfolio, we get, similar long-term returns, but we also get a reduction in risk. And that's that diversification factor.
Mm-hmm. Mm-hmm. So, and yeah, we should just kind of as a side note too, emerging markets as a subset of the international markets is actually negative for the year a little bit. Most of that is because of poor performance out of China as they changed regulations around a few of their housing companies and signaled that maybe the Communist Party wasn't as happy with some of the way the capitalist entities in China have behaved lately. And
Yeah, and if you look at,
that's
China, obviously a big factor, but if you look at the BRIC nations, Brazil, Russia, India, China, when you look at Brazil,
mhm,
obviously hard hit by COVID, the pandemic, and trying to figure out what's going on there, and a lot of the supply chain issues and things like that, I'm sure have hurt in these other countries as well. And so I think that's not
mhm,
unsurprising, but just like we said about international developed markets, this is a good opportunity as far as the valuations and the risk to have a piece of your portfolio for sure.
yeah, yep. So I think we've about covered it. Market's done well. Inflation continues to be a concern. We're still not certain what the health situation is going to be as we move forward here. It seems to be. It seems like it's not getting better, but we're starting to learn how to cope. I guess would be my point of view.
Yeah, absolutely. And I think, we say it all the time and it's kind of boring and, we don't, have any great tips of, hey, put all your money in this. But, at the end of the day, as we've seen before, there's bad stuff that happens all the time. As far, if
Mm-hmm.
you go back and look at the charts and look at all the things that happened, there's things that happen that, derail or affect stock market performance. But at the end of the day, having a diversified portfolio over the long run is really the best solution as far as growing your wealth and managing your portfolio and making sure you adjust that and the risk towards your goals and what your investment objectives are. But these things come up quite often, and the market is very resilient and usually figures it out and moves ahead. And I think that's what we've kind of seen this last, since the pandemic hit in 2020, and that's kind of what we're seeing right now.
Very good. Very good. The one thing I agree with Jim Cramer on, diversification is the only free lunch. So we'll stick with that.
There you go. I love a good free lunch. So, as always, if you have questions on this or any questions related to investing, feel free to reach out to info@srbadvisors.com. Like Dave said, we will put these charts up in the show notes for you to reference should you wish. And with that, Dave, I bid you a good afternoon.
You as well. Have a good weekend. I'll talk to you later.